You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so we still have some big stocks that are announcing earnings. We're on the tail end of earnings season. But last week we looked at Priceline and at a skip strike butterfly specifically in Priceline. Now, we did it approximately a week beforehand, and we talked about the fact that you would normally do it the day of or the day before they announced the earnings. Well, Priceline just announced earnings this morning. So based off of last week's trade, you would have adjusted it up a little bit because when we looked at the quotes on the underlying, it was saying that the last price was $1,880. And on the close before the announcement, it was approximately $1,905. So it was up quite a bit. That skip strike butterfly, if you would have used the strikes that we mentioned on the call without adjusting them at all, you would have been looking at buying the 2030 strike, selling the 2045, and buying the 2075. Well, now, a couple things happened in Priceline, which I found very interesting just overall. At the time, I did not realize that Priceline was changing the name of the company, which also means they were changing the stock. So it's now Bookings Holdings. So the symbol now is BKNG, and it's Booking Holdings Inc. is the new name for Priceline. But that stock is up $150. Now, if you would have adjusted your strikes, you would still be within the range. But considering what has happened, the open was up about $145. And if you had those strikes that we mentioned on last week's call, this trade would not be profitable in that it blew through our middle strike. Now, we also talked about the fact that when Priceline or Booking Holdings, which is, I mean, it's even hard to say, Booking Holdings Incorporated, if was announcing on a Tuesday, which means you had Wednesday, Thursday, Friday to trade on a $2,000 stock, that was a big deal. Like, there is way too much time left in those option contracts, and I'd rather have it be on a Wednesday or a Thursday that they announced. Thursday, the closer to the expiration, Friday is by far the best. Okay, so if you did adjust the strikes and basically do the same outlook that we had last week, you would still be in play here. The middle strike would have been the 2055 strike, and it actually is at 2055 right now, and would see how it all plays out. But whenever you do these type of trades, you do not want the stock to get to that strike instantly. You do not want to have a gap open. It doesn't give you an opportunity to trade that underlying. So just keep that in mind. An interesting trade that happened. I think if you did paper trade it, I think it'd just be very interesting to see where all the prices are at, what has happened with this underlying, everything else that's involved. I mean, if I look at an at-the-money option contract right now, exactly at 2055, these would be the option contracts that you're buying back. The midpoint on that underlying is 1790. So even though there's only 2 more days left, the vol has came off precipitously. It is not. It was trading at 54% vol when we put it on. That obviously increased as earnings were approaching, and it ended up right now. It's at 23% implied, and the at-the-money option contract is trading for about 1790. Let's just call it 18 at the midpoint. So if you're going to close out this trade, you obviously want the options that you're short to be as close to zero as possible. So we still got a lot of premium that would have to come off on these trades. Now, do you gamble the dice here and see, does it stay within this range for the next couple of days? And if it does, then this is obviously a very good trade. But considering what has happened on this underlying after the announcement on the earnings, this trade, you'd probably not be profitable at this moment if you adjusted your strikes and moved them to the 2040, 2055, 2075 strikes that we had actually, that would have been approximately where you would have been if you would have put it on the day of them announcing earnings, based off of the numbers that we talked about. Okay, so what would I do here? I would close it out. I don't want to incur any risk. And a stock that just gapped open 8 or 9%, gapped open more than the expected move. I don't know if I want to be in it with a couple more days of trading that are involved. Like I said, the ideal thing would be that it would just open up somewhere close to your long strike, which would have been 2040 in this instance, or even 2035. Then this allows you an opportunity to trade it a little bit and get a few more days of time decay, but a very interesting trade nonetheless. And I do love high price stocks that are announcing earnings. And this week, guess what? Costco Wholesale is announcing earnings. It's another, it's a $192 stock. It's not a $2,000 stock, but it does have some juice in it. And, you know, you're still a wholesale retailer. There's still a chance for movement. Anything can happen, but it is definitely not one of the internet juggernauts that are moving 100, 200 points like Amazon, even Apple. And Apple has just made a huge move up recently. And on top of it, Facebook, Google, those stocks have you never know what's going to happen after earnings. So I'm thinking with Costco Wholesale, I'm going to take this opportunity to look at a paper trade that's looking for less than the expected move as opposed to more than the expected move. And right away, a lot of people out there might be thinking, iron condor, where you want it to stay within a range. And that is a very viable trade that a lot of people would look at around earnings. I personally, with it being earnings and you have the juice in the option contracts, I'm going to look for less than the expected move, and I would rather use a butterfly, and at the money butterfly specifically, to do that trade. So if you'd like to follow along at home and you have the options playbook on your table, we're not going to mess around with skip strikes, but obviously I do enjoy butterflies, and I'm going to talk a little bit about a potential adjustment in a butterfly if it's gone wrong. Now, it gets a little bit crazier when you're talking around earnings, but we're going to look at the trade, and then we're going to look at that adjustment that would happen with that trade. So a long butterfly, and we're going to stick on the call side. There's no reason that you can't use puts on this trade because we're going at the money. right? So an at-the-money put butterfly is very similar to an at-the-money call butterfly, and they should be trading for the same net debit to the account for putting it on, if you're using the same strikes, of course. So a long butterfly spread with calls inside the options playbook is page 102. And if you don't have a playbook, as always, you can just run to optionsplaybook.com and you can check out, look under the strategies tab, and it should be easy to find. And we have Costco right now. We are taping this call at the market close, very close to the market close, on Wednesday, February 28th. And I took a screenshot of our platform right at this moment, and I see Costco right now is at 192.09. It's up $2 on this trading day. We have earnings coming up, but it's once again the same type of thing with Priceline. But I don't mind that we talk about the paper trade right now, but normally if you're going to do a speculative trade like this, you put the trade on as close to the market close the day before they announce earnings. So the announcement of Costco's earnings is going to be after the close on March 7th. Right now, it's currently February 28th. So obviously, I would want to put this trade on March 7th, but let's talk about with the stock at 192 approximately, what we might do with our butterfly. So first off, I'm going to go out and pull up the expected move for the expiration that contains that earnings. So if I look at the expected move for the March 9th expiration, right now they're talking about, it's $8.82 if we bought at the midpoints. So let's just round it up and let's call it $9. Okay, so plus or minus $9 is the expected move right now. I would expect that to change. I expect implied volatilities to go up a little bit and the expected move to move a little bit. We're seeing the implied volatility at 35% on the March expiration. The expiration before, which actually has a few days left, it does not contain the earnings, is trading at around 23%, just to give you some idea. So obviously, it's Costco wholesale. It's not Priceline. We have a more muted implied volatility, a more muted outlook from the marketplace as to what would happen. So what strikes will we use? We're going to do a standard butterfly. We're going to end up paying a net debit for that butterfly. So I would actually look for the most at-the-money strike. We have an expected move of around 9 points. So we're going to go just a little bit wider than that. We're going to go down to the 10-point level, mainly because we just want it to stay. We're hoping that it only does the expected move at a maximum if we put this trade on. So our ideal scenario would be that it moved 2 or 3 points in one direction or the other, and stay as close to the middle strike as possible. But here's the trade that we'll set up, and I'll give you where the current market is at. So if we do this trade, we are looking to buy the 182.50 strike call, approximately 10 points to the downside of the middle strike. We are then also going to sell 2 of the 192.50 strike calls, and then buy 1 of the 202.50 strike calls. So we got 182.50, 192.50, 202.50 are our strikes. We're going to use the expiration that is closest to the earnings announcement, which is, in this instance, it's going to be March 9th. That's 9 days away. So we'll be able to look at the earnings next week, and we'll be able to talk about this trade when that happens. And if you did that entire trade here, you can get that trade done right now for a net debit of $3.75. Okay, so that's going to be your max risk, $3.75. That also means that your break-even point on this trade is going to be within the expected move. So if you take 182.50, that's our lowest strike that we bought, and you add $3.75 to it, That makes our break even on this trade, if we wait all the way to expiration, is 186.25. So our ideal number on the downside is that it does not go below 186.25. And on the upside, we would take the highest strike that we bought, the 202.50 call. And in that instance, we're looking at taking 202.5 minus 3.75. And on the downside, or on the very upside, our break even is 198.75. So ideally, if we're going to hold this all the way to expiration, we want it to stay between 186.25 and 198.75. That's what we would like. And then this trade would be a very profitable trade. Now, if you put this trade on and it gaps open more than the expected move, get out. Just get out. You have $3.75 worth of risk. It's not a ton of risk relative on this underlying. You have $3.75 worth of risk, and you want it to stay within a range. You want volatilities to come in. You want the volatilities to go away on this trade, and you also want the time decay. You're going to have a few days remaining. March 7th is a Wednesday. I would prefer, as always, to go and do this trade on the 8th or on the 9th. I'd rather be on a Thursday that they announce earnings after the close, and then you just ideally have one trading day on Friday. But they're going to announce on Wednesday. So what are we going to do? We're going to use that expiration that's closest to that strike. It doesn't worry me as much in Costco as it would in Priceline or Booking Holdings, Inc. is the name of the company now. That's a mouthful. So if I go and look at this underlying trade, what we're looking for is less than the expected move. We're hoping that it will expire in a hurry. We're doing a long butterfly, and let's recap the actual strikes and the expiration. All of these option contracts are expiring on March 9th, 2018. We're buying the 182.50 call, selling 2 of the 192.50 calls, and buying 1 of the 202.50 calls. All right. Net debit to the account is $3.75. That's the max risk. The maximum that this could trade to the upside is actually 10 points wide if you got lucky enough that it went out right at your middle strike, 192.50, right at the expiration date. And so you do have 10 points worth of upside minus the 375 that we put on. The maximum upside would be 625 on this trade. All right. But if you get it, once again, I think you get the stupid award for it because you should have been out of the trade a lot longer before the market closed, and as opposed to expecting this thing to peg right at the short strike in your butterfly. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's the options with an S, guy at invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.